Start recording. Yes. Share the screen. Cool. All right. So is there anything from your side? I've been talking a lot. Is there anything from your side that you guys want to quickly just make mention of before we get into what I have for you today? About the test, about generally how it's going. Maybe anything that you would like us to do as we approach the final, final stages of this module. Guys, think about this, eh? Think about this. No, yeah, we've had a nice lengthy discussion. That's fine.
So to
But-
be honest, I forgot. I don't know. I forgot about the test completely. I did it, but I'm saying whatever was inside.
Yeah, you forgot what was actually. Yeah, it's been a while. Hey, we had quite like 3 weeks. Haven't seen each other. So the test, from what I recall, the first question was on depreciation. Second question was on property, plant, and equipment calculation. Then the last question was on the adjustments. That was now your unit 4, but it was in the general journal. Yeah, so that was the test. Okay, but yeah, again, well done to you guys. I was quite happy. I know I said there were some who you could see the calculations and the things they were doing, they didn't know what they were doing. But I also looked at the YouTube channel and how many people were viewing the YouTube channel, and obviously there was a huge spike. So I'm glad you guys are also making use of those resources because that's why it's there. So let's keep it going. I'll be very, very honest with you. I obviously, I never check my averages, but I can tell you this now that I could see the trend, and this is across all my groups. The trend was a lot better than in the past. And that's why I'm saying, like, even those who didn't manage to get above 50, I mean, it was like 40 something. So we're still in the game because, again, remember, there's the 10%, which as long as you did your ICE task, it's a done deal. Okay. So literally, you should be able to make CAS, and then you just need to make sure in the exam. But anyway, let's get into today's lecture. All right, so Unit 6 is close corporations, okay? Now, CCs, this is just a different form of business. We know that we have PTYs. We know that we have what other partnerships? We have sole traders, all right? So CCs is just another form, okay? And since May 2011, you're no longer able to register a new CC. So if you do get a CC, it's because you've acquired one that was existing prior to that. And obviously, but I don't think that there's really any massive advantage to having a CC. Distinct characteristics, legal existence, so it's a separate legal entity in and of itself. Okay, these things I think you guys already know, right? These are things you guys know. Limited liability, so they can only take the resources from the CC. They can't come and take your personal resources. And then perpetual succession, obviously that's in reference to if I die and all of us are part of the CC can continue to exist and so forth, so forth. Non-compulsory meetings. When it comes to companies, PTY, private companies, we have to have an annual meeting every year. With CCs, you don't need to have that. Members can also be a part of management in CCs. CCs can hold shares in companies, but companies can't hold shares in CCs. All right. And the rest of the stuff you can really read. Okay. All statutory information is contained in a single document called a funding statement. Okay. A member or employee of the CC may be appointed as the accounting officer. Okay, provided they obviously have the necessary qualifications and ability to obviously run that position. So those are the advantages. At the same time, they're also highlighting the characteristics and stuff. Disadvantages, you can, in a sense, become personally liable, all right, as a result of one of the partners going and committing to something financially that they shouldn't have, or agreeing to something that it will result in loss for the company. All right, every member is an agent of the CC. That's a problem. Because there are some people who should not be agents for us, eh? Okay? They need to just enjoy their profits and sit down and keep quiet, okay? Not everybody needs to be an agent for the company, okay? And then a member or members together holding an interest of at least 51%. This is pretty much the same in companies as well and other, entity types. If I own 51%, that means I can make decisions on behalf of all of you, and vice versa. If you three have 51%, you can obviously say, we voted, we're going to go this direction, and there's nothing I can do. Makes sense. So that's all they're highlighting there. Then a CC no longer automatically exempt from being audited. Okay, this is one of the reasons why people like CCs, because you don't have to have audited financial statements. All right, but now not necessarily the case. They've tried to bring in some legislation to kind of, put you on actually requiring it to some degree. Okay. Then this is what we are going to be playing around with in this unit: member funds, all right, and member net investment. You'll see that. So I don't want to get into this because it won't make any sense. Okay. But all that we are interested here is, what's your share in the CC? What's your share in the CC? What's my share in the CC? And then how much are we then each entitled to by way of the profits? Make sense? That's what we're pretty much discussing over there. Okay. Examples of ways in which the percentage interest of members of a CC can be changed. Trying to think. Okay, so in your text, we'll go to the first example. I think it's example 6.1. Welcome. Okay. Let's see here. I'm just going to discuss the stuff, okay, in the interest of time, because I want us to also do Unit 7 as well today, at least the slides for Unit 7. So literally today we will have finished Accounting 1B. Aren't you guys excited? Very soon you will not be seeing me.
So that means you have to write.
That means you have to write. I know we're not worried about that because you're going to pass. I mean, okay, so in there, what's the first example that they give? The scenario, the first scenario that they give there. Someone can read it out to me whilst I flip to it. First scenario that they give, and then they're just trying to illustrate.
It's basically a member resigning. A
member resigning. Okay, so what's happening when a member resigns? Basically, I own 20% in this business, and then I'm all the way in the answers over here. Sorry, guys. 1.8. Okay, 1.84 in my textbook, but I'm here now. So a member resigned in the first scenario. Okay, which member resigned here? It was member D. No, sorry, I mean questions. You're right. It is 181. Okay, right. So a member resigned. Which member was it? Member C. Okay. So in this scenario, okay, the calculations are on the board, which is perfect. In this scenario, what they're saying is member C had 30%. All right, and we just began, so you haven't missed anything, by the way. Okay. So since I'm no longer part of the company, what's going to happen is they're going to pay me whatever money that I had in the company and any retained, whatever contribution, capital contribution, I'm just going to call it capital contribution, and whatever retained earnings I had in the company. Okay? Because I'm leaving. Does that make sense? Now, the remaining, my 30% is going to be split between you guys. Does that make sense? And that's what's happening here. So they take that 30%, and while they look at the percentages of the remaining members, here it's only A and B. A had 50%, B had 20%, total of 70%. Does that make sense? So we're saying, okay, let's split that between the two. So for member A, how much is his interest or shares in the company going to increase by? We say 50 over 70 times 30 and that gives us 21.4. Okay, then we say, okay, for member B, he has 20% currently before this resignation, over 70% times the 30, he's going to get 8.6. Okay, and then we obviously add that to their present shares. Okay, and that's how that then changes. Okay, right. So there obviously you can see they're showing you how it was before, and they show you how it is after. Can you see their new interest? They've added those together. Does that make sense? Yes. The member, yes. So here, let's read below there. It says, there will be no transfers made in funds between members A and B, okay? Because the whole amount is paid out to CC's bank account. So paid out of the CC's bank account, unless there is a premium involved. Only member C's funds are paid back. Therefore, member C's funds decrease. Okay, so here they didn't give you the background to say how much capital and retained earnings does member C have in the business at this point in time. They just informed us that they've resigned. Does that make sense? And they gave us how much shares. But if I had put in 20,000 into the business as capital, right? And I had retained earnings of, let's say, 5,000. The CC was going to pay that money to me on my departure. Does that make sense? And then I would leave. Okay. All right. And then obviously these guys would then have the remaining shares. Okay. Right. Excellent question. You'll see more of that as we go along. All right. Then we move on to second scenario. Second scenario, we have a new member joins the CC. Okay. Then there you can see up top it says member A 50%, member B 20%, member C 30%, and then member D doesn't have any shares. He's just joined. Okay. Say member D joins and acquires 20% in the CC with a contribution of 20,000. Can you see that's the capital that is put into this CC? Here they like to call it contribution, but it's just a capital injection, capital contribution. Okay. All right. There will be a change in percent interest. Okay. And again, interest, you'll keep seeing percentage interest, but it's the same as saying, what are the shares? Okay, so I don't want you guys to get lost in the terminology. All right, cool. Member A, okay, so how did we calculate this? I just want to show you what they've done here. What we do is we say, how much shares did member A had? Member A had 50%, right? So 50% times 20%, because each of these members must contribute 20% of what they currently hold to member D, so that he can have his 20%. Does that make sense? So if I'm member A and I have 50% of the company, he's going to take 20% of that. And that is equivalent to 10%. Does that make sense? Okay. So 10% of member D's shares are coming from member A. Then we move on to member B. Member B only has 20% of the CC. All right. So 20% of 20% is only 4%. We're going to deduct 4% from member B to give to member D. All right. And then finally, member C has 30%. So we're going to deduct 6% from him. All right. Because 20% of 30% is 6%. When you add those together, 10 plus 4 plus 6, you get. All right. You see, makes sense, huh? Okay. Cool. Right. So that's how we do that when a new member joins. Okay. All right. That's the first thing. Then, what else must happen? We see there will also be a transfer in funds from member A, B, C to D. All right. Since D has bought existing owner's equity. Okay. So there'll also be a transfer of money. Okay. So assume the following fund balances before D was admitted. Okay. So when we say fund balances, we're saying what their capital, that's members' contributions, and what their retained earnings. Remember retained earnings, what we said retained earnings is? our business has been existing, we've been making profits, right? But then we said, ooh, guys, let's not eat all the money. Yeah? Let's save some so that we can further the business activity. Okay? So we can save it for marketing, save it for buying whatever else we need, equipment, etc. That's retained earnings. But we keep record of the fact that based on how much profits we had, let's say there was 10,000 profits, okay? Let's say there was 20,000 profits. We paid out 10 amongst ourselves, well, 5 of us right now, right? So 2,000, 2,000, 2,000, 2,000 each, okay? We paid out 10,000, but remember we had 20,000. So the other 10,000 is therefore obviously retained earnings. So each of us were actually entitled to 4,000 each. But we said, no, we're only going to pay out 10,000. Does that make sense? So we keep record that we each are owed 2,000, 2,000, 2,000. I'm just trying to illustrate this retained earnings so we all know exactly what it's all about. So that's retained earnings. Now, so there you can see the capital contributions or members' contributions, and then there's the retained earnings. So member A had 5,000, member B had 2,000, the member C had 3,000. Sharp, cool. So the total funds for member A, they're 15,000, member B, 10,000, and member C, 15,000. Okay, cool. Now, when we say, obviously member D is now coming into this business, right? And he's paid his 20,000 to buy into this business. So we have to give him a portion of the retained earnings. We don't give him a portion of our capital contribution. Does that make sense? Because that's the money we put into this business when starting. Just like he's put in his 20,000. So we then say, okay, for member A, remember member A had to give up 10% of his shares in the business to member D. So we say, okay, what is member A's retained earnings? Is 5,000. So you can say 20% of 5,000, you're going to get 1,000, and that 1,000 in retained earnings is going to be handed over to member D. Does that make sense? Okay. And we continue to do the same thing for member B. 20% of 2,000 is 400. 400 is going to be paid over to member D. 20% of the 300 retained earnings for member C is 6. Whoa, I think this is supposed to be 3,000, maybe. Yeah, it's supposed to be 3,000. Sorry, I forgot to put another 0 there. That gives you 600. 600 needs to be paid over to member D. And now he has a total retained earnings of 2,000. So you can see in your books, they don't explain that. They just put the 600, 400, and 1,000. Okay. All right. So just take note of that. Okay. So there we can now see the new total funds. Member A has 14,000, member B 9.6, and then member C 14,400. Okay. Last illustration. Then we'll go back to our slide. Illustration 3, an internal transfer. An internal transfer, okay. Interest before transfer, there we have it. Okay, nothing new there. Then say member B buys 10% of interest in the CC from member A. Okay. So here, be very careful. I'm warning you now. You have to, when you see a question like this or a situation like this, read it carefully. 10% of interest in the CC means 10% of the company or the entity. Does that make sense? Sometimes the question will say 10% of the interest that member A had in the business. That's something different. Why? Because what you're saying is member A has how much? 50%. And here they're saying we want 10% of his interest. Right? He only has 50%. He doesn't have 100% of the business. Does that make sense? So what we're saying is 10% of 50%. Because that member only has 50%. Are you guys with me on that? Makes sense. Yeah. It's so easy to miss that. All right, in the test or exam. So pay attention to buys another 10% of interest in the CC or 10% interest in that, in a specific member's interest in the CC. Does that make sense? But you'll see this when we go through a question, right? But let's proceed. So here we take straight 10% because it's in the CC. In other words, the whole 100%. Okay. So member A obviously has 40%, member B, then we increase it by 10%, he now has 30%. Obviously, member C, nothing, he's not involved in this transaction, so he's not affected. He remains with his percentage. But now we know we also need to transfer over retained earnings and capital contribution. In this scenario, we also have to transfer some of the capital contribution from the member who's selling. Okay, so there you can see, let's scroll down. Okay, so here I'm just showing the calculation. You can actually just ignore this first bit because we already know that his contribution is 20,000. So 20,000 times 10%, you have 2,000. Okay. Then obviously we know that his retained earnings is 10,000. Is it 10,000? No. His retained earnings is 5,000, isn't it? Oh yes. These calculations are right. Remember, it's 10% in the CC. Does that make sense? So there's two ways you could have done this. So this is why we're now saying, okay, fine. What is the whole value of the business? So we know that 50% is equal to 10,000. Does that make sense? Because we know member A has 50% of the company. So we're using proportion. What do we want? We want the whole size of the company, which is 100%. What we have though, rand value, is 50% rand value, which is 10,000. And we know what we have percentage-wise is 50%. So that's how we're then getting to the whole value of 20,000 for the whole company. Then 10% of that is giving us the 2,000. Okay. Right. So that's, we apply the same logic to get the value of retained earnings for the whole company. Then we say 10% of the retained earnings for the whole company, we get 1,000. Okay. Again, that's something that's not in your textbooks. Okay. There's different ways you could have done this calculation as well. What you could have also done is you could have said, we know that we're giving 10% of the whole company. Okay. So we could have said, what is 10% of the whole company in proportion to Mr. A's shares? Okay. And if you do your calculation correctly, you would have ended up with 20% of Mr. A's shares is equivalent to 10% in the business. Okay. So you would have then just gone 20% of 10,000, which would then give you 2,000. 20% of 5,000, which would then give you 1,000. Makes sense? So there's different ways to skin the cat. Okay. Right. So that's that. And then obviously we're changing the membership contributions and the retained earnings for both member A and member B. Again, this doesn't affect member C because they're not involved in the transaction. And you can just read through that paragraph in your own time. It's just reiterating the fact that when there's an internal transfer of shares, we know that both retained earnings and capital contributions or member contributions is going to be affected, as well as the shares or the interest of the members. Okay. Happiness there? All right. Awesome stuff. Let's get back to our slides then. Okay. Right. So we've gone through the examples. Okay. Financial statements. There are two statements of particular. There are two statements in particular that are often used when preparing the financial statements of the CC. These are statement of changes in members net investment. Okay, that's what we'll be playing with primarily. And then transactions with members. Transactions with members, it's transactions between the company or the CC in this case and the member. Does that make sense? Direct transactions with those two. And then statement of changes in the members' interest, net investment. Now we're saying it's what we were just doing to say at this point in time in the financial year, somebody bought into the business or bought into the CC and wanted a portion of the CC. Somebody resigned. Somebody bought shares from another partner directly. It makes sense. That's what's going on in the statement of changes in members' net investment. Okay, then final accounts of a CC. 3 final accounts are drawn up at year end, namely trading account, profit and loss account, and then the appropriation account. Okay, so we've seen all these accounts. Okay, when we did what was it? Partnerships. Yes, that was the last unit. Partnerships. We did appropriation account. We also have an appropriation account in CCs. Then here, the Act requires annual financial statements must be disclosed separately. The aggregate amounts as at the end of the financial year, each of the following: contributions by members, retained earnings, revaluation of property, plant, and equipment forming part of the components of equity, amounts of loans to members, amounts of loans from members. Okay, so this is just highlighting the stuff that has to be in the financial statements. You'll see this in both. You'll see this in the statement of net investment, okay, what we just talked about, and then in the transaction with members, you'll see all of this stuff there. Okay, and that's your unit 6 from a theoretical perspective. Okay, now I want us to get into unit 7. And we're going to finish unit 7 before the break. I actually thought we would get into a bit of an exercise before the break, but it seems like we'll only manage to finish the slides for unit 7 as well. Okay, so unit 7, guys, it's a combination of everything that you've pretty much learned in 1A and 1B. Okay, it primarily is looking at informal and formal businesses or accounting systems. Okay? Fine. Okay, I'm just going to leave it because clearly not winning here. One reality of the modern world is that accounting records are not always in good shape. The bookkeeper or accountant often inherits a set of books that are in complete disarray. Guys, you got no idea. And is then required to put the pieces together to come up with a set of books which shareholders can interpret. The reason why we do accounting is to understand, did we make a profit? Did we make a loss? What assets does this business have? What liabilities does this business have? So that you guys as shareholders can begin to say, should we invest in this business? Is it a bad business or a good business? All right? Should we just give up with your management? All right? All those things. That's why we do this here. I love the practical side of accounting. Why? Because now it's not just about making statements and all that kind of jazz. It's now about, okay, based on the information that we see in the statements, what then should we do? Okay, it's an excellent, accounting is an excellent strategic tool. Okay, and that's what I love. That's why I studied finance, by the way, just so you know. Okay, so I'm not a CA, but I think you guys know this, that I'm not a CA. So I just don't want to say certain things right now because I know we're recording. So, but yeah, I would say more, but yeah, accounting is excellent in that regard. Okay. Record keeping in the informal sector. So now they're talking about businesses in the informal sector. And typically you would get street vendors, all right, people who sell fruits and vegetables on the corners, okay, people who basically bake cakes, all right, and then people who are also selling local artifacts. I think we see these guys a lot at the markets and stuff, okay? Those nice little wooden stuff, you know, they got their beads and bracelets that they can hook us up with. Then car guards as well, all right? And then obviously unregistered motor mechanics, okay? We also know people there. They in the township, sometimes we also get guys who, they just switch up their garage and then they can obviously fix cars. And these guys can actually do a very good job, okay? So that's the informal sector, okay? Obviously, we have a skill, we're applying it, we can get some money off of it. We're trying to, you know, obviously make that happen and get by, okay? So now, there's a delay I can see here with the slide and the projector, but oh well. So anyway, these people may want to start to draft financial statements and have their books in order, because now they want to go to FNB and show FNB, I'm actually making a profit. I'd like to have some money. I'd like you to inject some money into my business, etc, etc. Okay. So unit 7 is about how do we take these informal businesses with the information that they have and then populate proper financial statements. That's what it's all about. So if you've been playing in 1B and 1A, that's over here. Okay. Now here's the good part though. They don't usually ask you this. Just being honest with you. Okay. And how we're going to prepare for Unit 7 is obviously when we do revision via the papers that we. But even there, you'll see that there's not too many questions. But you'll see when you go through the questions in your own time, or just have a look at it, you'll see that literally it's about creating an income statement based on the information provided. Okay, that's all that it is. Creating a balance sheet based on the information provided. Okay, these businesses mostly generate very small profits, which means that they are not liable for tax, and the people who run the businesses mostly have little knowledge of the formal accounting system, yet they need to exercise a measure of control in order to survive. Okay, all right, so it's not only about producing statements so that you can get investment, all right, or just become a little bit more professional, but also so that you can monitor your stock, for example, create control, see what's coming in, see what's going out. Okay, then yeah, on that last slide, you'll see in your textbooks around 211, you'll see the differences between the two, informal and formal accounting. All right. So here they're now talking to single entry system. Despite the incomplete nature of the data provided by the system by micro businesses, usually that's the term they refer to or use to refer to small businesses. Considering oftentimes it doesn't take into account the effects of transactions on assets, liabilities, and owner's equity. Okay. All right. So nonetheless, this data can be used to draw financial statements. Okay. So basically what they're trying to tell you there is, despite the data being incomplete, right, when it comes to single entry systems, because you'll still find that an entrepreneur running a spaza shop will list the fact that, okay, I bought these goods from market, and this is how much I bought each of them for. Because they really do record this stuff, because obviously they want to resell. You're not going to sell at the same price you bought for. You're going to increase it. So you need to write down, or at least be aware of how much, so that you can increase your price. So they'll write down, bought this much, this is how much I'm selling it for. So they can finally calculate, am I making a profit? Can you see they didn't begin to record trading inventory, all those things. They just record their money left, money came in. This is what we are left with. Does that make sense? So that's single entry. Okay. Double entry, remember the double entry system? We're counting whenever we buy inventory, whenever we sell inventory, we're saying cost of sales. Does that make sense? There's always two accounts, at least two accounts that are affected. Okay. These guys, when they buy something, they're not recording input VAT. Does that make sense? But they are actually experiencing input VAT. You see what I'm saying? So those are the things we're obviously talking about. Okay. Advantage of single entry system, simplicity. It's easy. It's easy. Okay. They are usually less expensive to maintain than double entry systems because they do not require the services of a trained person. This is why I was saying, I usually say this to my SAGE students, that you guys are in a privileged position. Because with that, I never did SAGE when I went to school, by the way. I only did SAGE here, when trying to teach you guys. But if you know accounting, SAGE is not an issue. You guys have already done SAGE, right? You do it in second year. You haven't done it this year. Okay. But I know the degree program guys also do SAGE. So maybe it's a second year thing. I don't know. If it is, that's even better because I think having the accounting knowledge is good for when you actually do SAGE. Yeah, so you know what the computer is actually doing for you. Because everything that you're doing here, the double entry, the computer does that for you. All you need to do is insert it in the right places and the rest is history. Then you can go and populate your income, balance sheet, all those statements, it will automatically do for you. So it just makes life. And in the real world, that's what happens. We don't have somebody who's debit, credit, all this. No, it doesn't work like that. No, it's inefficient. It's inefficient. Okay. All right. So disadvantages of the single entry system. Data may not be available to management for effective planning and controlling the business. Lack of systematic and precise bookkeeping may lead to inefficient administration and reduced control over affairs of the business. If we don't know how much trading inventory we have, people can steal. All right. Or we accept orders, but we don't have enough trading stock to fulfill those orders. Can you see the number of problems that can arise? Okay. Also, at the same time, we might not know we have enough funds to pay salaries. Okay, so there's a whole sort of all sorts of stuff that can happen. Single entry recording, single entry records do not provide a check against clerical errors, as does double entry system. See, if something doesn't balance in accounting, you already know something needs to be. I made an error somewhere. Okay, this is one of the most serious defects of single entry systems. Single entry records seldom make provision for recording all transactions. In addition, many internal transactions, such as adjusting entries, are often not recorded. We barely ever say, "Okay, it's year end. Let's close the books and all that stuff." We don't do that. All we really care about is, are we making a profit or a loss, usually with single recording. Because no accounts are provided for, many of the items appearing in both the statement of profit or loss and other comprehensive income and the statement of financial omission of important data is possible. Okay. So yeah, because we're not doing double entry, obviously there are certain accounts that won't be actually acknowledged in these different financial statements. In the absence of detailed records of all assets, lax administration of these assets may occur. Okay. All right. Trying to think of an example. Okay. Theft and other losses are less likely to be detected. Okay. I think that much we've already established. Okay. Then here are now the steps to transforming the single entry system. All right, so that you can have your financial statements. The following steps should be followed when transforming a set of records from a single entry system to a fully operational double entry system. Okay, gather as much data as possible: bank statements, check counterfoils, receipts, other source documents. Can you see now why I was saying, if you don't know what this source document, what type of transaction it then yields or results in, then we've already lost. Okay? Because you won't know which journal should be affected. From the journals, you don't know which account should be affected. from accounts you cannot then post into the general ledger, the debit and credit. That's obviously affected. From there, you won't have a proper trial balance. From not having a proper trial balance, how are we going to have a proper income statement or balance sheet? Does that make sense? So that's what we're doing here. We're gathering as much information so we know what source documents are affected. Then from there, we're determining the value of non-current assets from the available information. This guy has a car or a delivery truck. Okay, that's a non-current asset. Cool. What else do they have? Do they have stoves? Do they have? We're jotting that down. When we now know what non-current assets, we also know, depreciation also needs to be accounted for. Can you see? But you have to know these things. If you don't know these things, when they give you this question, dololo. You now get what I'm saying, huh? Okay. Then determine the fair value for inventory by means of a stock take. Okay. How much inventory do we have? How much did we buy it for? Remember, inventory is always on cost. Okay. If you don't know that principle, again, it's hard times for you. Calculate owner's equity at the beginning of the financial period by deducting total liabilities from total assets. If you don't know that owner's equity is equals to assets minus liabilities, how are you going to calculate owner's equity when the question comes? Okay, so that's why I say this unit is literally a recap of everything that we've done. Okay, moving on, step 7, prepare the cash book, post to the appropriate accounts. If you can't do the journals, we did this in 1A, where you create, where we know, okay, the source documents affect the debtors journal, the debtors allowance journal, this, cash book, this. You can't do this. Okay. Determine the sales from the debtors control account and the purchases from the creditors control account. Transactions done on credit, basically. Then make adjustments of the amounts still outstanding or to be paid. Okay. How much are we owed? How much do we owe? Okay. What are our debtors or creditors? Draft up a trial balance. Okay. Can you see now what I was telling you? When we're now done with the journals, when we're now done with the ledger, we can only then draft up a trial balance. Okay. And then draw your income and a balance sheet for the period. And you're done. So that's what Unit 7 is all about. That's what Unit 7 is all about. So again, we're not going to do like literally any question in Unit 7. Okay. But based off of that theory and what we've done in 1A and 1B up until this point, you should be able to do this. Okay. Cool. All right, that's it. Let's just take a breather. Then when we get back, we'll do exercise 6.2. 6.2. So